Are you worried your city could be the next housing market disaster? If you own a home, are thinking about buying, or just want to protect your finances, you need to hear this. The headlines are screaming about a 2026 housing crash, but what's really going on? And which cities are in the most trouble? Today, I'm breaking down the top 10 US cities facing the toughest downturns, and what it means for you. But before we dive into the list, let's pull back the curtain on what's actually happening beneath all the noise. If you've seen headlines about the 2026 housing market, you've probably noticed a lot of doom and gloom. The media loves to focus on the most dramatic stories, and right now, that means a lot of talk about falling prices, rising interest rates, and uncertainty for buyers and sellers alike. But is the situation really as dire as it sounds? Let's dig deeper. The truth is, while there are certainly challenges, the market is not collapsing everywhere. In fact, the national picture is much more nuanced than the headlines suggest. Some areas are experiencing price corrections, but others are holding steady or even seeing modest growth. The key is understanding the underlying factors driving these changes. There's talk of a crash and comparisons to 2008, but this isn't a repeat of the last crisis. Back then, we saw a perfect storm of risky lending, over-leveraged buyers, and a total collapse in confidence. Today, things are very different. In 2008, the housing market was built on a shaky foundation: subprime mortgages, adjustable-rate loans, and buyers who often had little to no equity in their homes. When prices started to fall, the whole system unraveled. In 2026, the fundamentals are much stronger. Lending standards have tightened significantly since the last crash, and most homeowners have real skin in the game. The average credit score for new mortgages is much higher, and banks are far more cautious about who they lend to. This means that even as prices adjust, we're not seeing the same wave of defaults and foreclosures that we saw in the past. Lending standards are tighter, and most homeowners have real equity. That means people aren't as vulnerable to sudden price drops as they were before. Banks are being much more careful about who they lend to, and most homeowners have built up significant value in their properties over the past decade. This cushion makes a huge difference when the market gets rocky. In fact, according to recent data, over 70% of homeowners have at least 30% equity in their homes, a stark contrast to the pre-2008 era. This equity acts as a buffer, reducing the risk of foreclosure and forced sales, even if prices dip temporarily. Additionally, the majority of homeowners locked in historically low interest rates during the pandemic, making their monthly payments more manageable even as rates rise for new buyers. We're not seeing reckless lending or mass foreclosures. In fact, foreclosure rates are still near historic lows in most areas. The vast majority of homeowners are staying current on their mortgages, and there's no sign of the kind of panic selling that triggered the last crash. Instead, what we're seeing is a market that's adjusting to new realities: higher interest rates, changing demand, and shifting economic conditions. It's important to note that while some buyers are being priced out due to higher mortgage rates, others are waiting on the sidelines, hoping for better deals. This has led to a slowdown in sales volume, but not a flood of distressed properties. Inventory remains relatively tight in many markets, which is helping to stabilize prices even as demand cools. What's happening now is a localized correction, not a nationwide meltdown. Some cities are definitely feeling the pinch more than others, especially those that saw the biggest price run-ups during the pandemic years. But in many places, the market is simply cooling off after an unprecedented boom. It's important to remember that real estate is always local, and what's true in one city might not be true in another. For example, cities like Austin, Boise, and Phoenix, which experienced explosive growth and bidding wars in 2021 and 2022, are now seeing the sharpest corrections. Meanwhile, markets in the Midwest and parts of the Northeast remain relatively stable, with only modest price adjustments. Local job markets, population trends, and housing supply all play a role in how each city is affected. Today I'll take you city by city through the 10 US markets facing the toughest downturns in 2026. We'll look at what's driving the changes in each area, which neighborhoods are most affected, and what it means for buyers, sellers, and investors. Whether you're worried about your home's value or looking for opportunities, understanding these local trends is key. We'll examine factors like job growth or loss, migration patterns, new construction, and affordability challenges. I'll also highlight which segments of the market, starter homes, luxury properties, or rentals, are seeing the biggest shifts. By the end of this video, you'll have a clear picture of where the risks and opportunities lie in today's market. If you're thinking about buying, selling, or investing, these are the places to watch. I'll break down the data, share expert insights, and help you make sense of the headlines so you can make smart decisions in a changing market. We'll talk about strategies for navigating higher interest rates, tips for buyers looking for value, and what sellers can do to stand out in a slower market. Plus, I'll share resources for tracking local trends and staying ahead of the curve. Let's dive in and see what's really happening in the US housing market right now, because the more you know, the better prepared you'll be for whatever comes next. Not long ago, Austin was the talk of the nation, one of the hottest housing markets in America, drawing headlines and hopeful homebuyers from across the country. The city's vibrant culture, booming tech scene, and promise of opportunity made it a magnet for newcomers. People flocked to Austin, eager to stake their claim in what seemed like a never-ending real estate gold rush. The city's population exploded, with tens of thousands of new residents arriving each year, lured by the prospect of high-paying tech jobs, a thriving music and food scene, and a lifestyle that blended urban excitement with Texas charm. Just a few years ago, open houses were packed, bidding wars were the norm, and homes often sold above asking price within days. The energy was electric, and it felt like the good times would never end. Buyers were waiving inspections, offering cash, and sometimes even writing heartfelt letters to sellers in hopes of standing out. Real estate agents worked around the clock, fielding dozens of offers on a single property. The city's housing inventory couldn't keep up with demand, and prices soared at a pace that stunned even seasoned market watchers. Home prices skyrocketed as tech workers relocated from Silicon Valley, and investors poured in, eager to capitalize on the city's rapid growth. Construction cranes dotted the skyline, and new neighborhoods seemed to spring up overnight, fueled by the belief that demand would keep climbing. Developers raced to build, transforming once quiet suburbs into sprawling communities. The influx of remote workers during the pandemic only accelerated the trend, as people sought more space and a lower cost of living compared to California or New York. But now, the story is changing. Austin faces a classic case of oversupply. Too many new homes, and not enough buyers to fill them. Listings are piling up, and houses are sitting on the market for weeks, sometimes even months, as the frenzy cools. The once frenetic pace has slowed dramatically, with sellers forced to wait longer and longer for offers. Some neighborhoods are dotted with for sale signs, a stark contrast to the bidding wars of just a few years ago. Sellers are feeling the pressure. Price reductions are becoming more common, and agents are working overtime to attract buyers. The days of instant offers and bidding wars are fading, replaced by a new reality where patience and flexibility are key. Many sellers who bought at the peak are now facing the prospect of selling for less than they paid, or holding on to properties longer than expected. Some are offering incentives like covering closing costs or including appliances just to sweeten the deal. Investors who bought at the peak of the market are now facing tough choices. Many are dealing with negative cash flow as rental rates soften and mortgage payments remain high. Some are even considering selling at a loss, hoping to cut their losses before prices fall further. The rapid appreciation that once made Austin a darling for real estate investors has reversed course, leaving some over-leveraged and struggling to cover expenses. For those who purchased multiple properties, the financial strain is even greater, as vacancies and lower rents eat into profits. The rental market is also feeling the strain. With more units available than ever before, landlords are competing for tenants, offering incentives and lowering rents just to keep properties occupied. Vacancy rates are rising, and the days of easy profits are over. Some landlords are offering free months of rent, reduced deposits, or upgrades to attract tenants. The competition is fierce, and many smaller landlords are struggling to keep up with larger apartment complexes that can afford to offer more generous deals. Still, Austin's market isn't collapsing. Instead, it's going through a much-needed reset, a period of adjustment after years of runaway growth. The city remains vibrant, but the housing market is finding a new balance. Experts say this correction is healthy in the long run, as it brings prices more in line with local incomes and prevents the kind of bubble that could lead to a more severe crash. The fundamentals of Austin's economy, its tech sector, universities, and cultural appeal remain strong, providing a solid foundation for future growth. Today buyers have more negotiating power than they've had in years, while sellers must be realistic about pricing and expectations. The boom may be over, but Austin's next chapter is just beginning. For those willing to adapt, opportunities still exist, whether it's finding a deal on a home, investing for the long term, or simply enjoying the city's unique lifestyle. As Austin's housing market resets, both challenges and possibilities lie ahead, shaping the future of one of America's most dynamic cities. Not long ago, Phoenix was the poster child of the pandemic housing boom. People flocked to the Valley of the Sun, drawn by affordable homes, warm weather, and the promise of a fresh start. The city's real estate market was sizzling, with bidding wars erupting over even modest properties. Home values soared, and sellers could barely keep up with the demand. Phoenix became a magnet for remote workers, retirees and families seeking more space and a lower cost of living compared to coastal cities. The influx of new residents drove up prices at a record pace, and for a while, it seemed like the good times would never end. But now, the story has taken a dramatic turn. The once red-hot market is cooling rapidly, and the momentum has shifted. The streets that were once bustling with eager buyers and moving trucks are now lined with for-sale signs, and open houses that used to draw crowds are eerily quiet. The construction boom has slowed, with developers pausing new projects as uncertainty grows about future demand. As mortgage rates have climbed to levels not seen in years, affordability has plummeted. Many would-be buyers are finding themselves priced out, unable to qualify for loans, or unwilling to take on higher monthly payments. The average 30-year fixed mortgage rate has more than doubled since the pandemic lows, pushing monthly payments hundreds of dollars higher for the same home. This has created a significant barrier for first-time buyers and even move-up buyers, who now face the prospect of trading a low-rate mortgage for a much higher one. The excitement of the boom has faded, replaced by anxiety and uncertainty. Many families are putting their dreams on hold, waiting for rates to drop or prices to fall further. Inventory is piling up. Homes that once sold in days are now sitting on the market for weeks, sometimes even months. Overgrown lawns and empty driveways are becoming a common sight in neighborhoods that were bustling just a year ago. The number of active listings in Phoenix has surged, giving buyers more choices, but also signaling a market in transition. Sellers are growing increasingly anxious as showings dwindle and offers become rare. Some are even pulling their homes off the market, hoping for better conditions in the future. Many families who dreamed of home ownership are now forced to wait, disappointed by the reality of higher costs and fewer options. Sellers, too, are feeling the pinch, as offers dry up and open houses go unattended. The emotional toll is real. Buyers are frustrated by the lack of affordability, while sellers are grappling with the end of easy profits. Some families who stretched their budgets to buy at the peak are now worried about declining home values and the risk of being underwater on their mortgages. Investors who once snapped up properties are now facing a different challenge. With rent growth stalling and vacancies rising, the math no longer adds up for many landlords. Some are even struggling to fill their units, as renters look for better deals elsewhere. The rapid rent increases of the past few years have hit a ceiling, and with more rental units coming online, competition among landlords is fierce. Some investors are choosing to sell, while others are offering incentives like free months of rent or reduced deposits just to attract tenants. The migration that fueled Phoenix's boom has slowed dramatically. Fewer people are moving in, and the city's population growth is tapering off. The factors that once made Phoenix so attractive, affordability, job opportunities, and lifestyle, are now being challenged by rising costs and a cooling job market. Companies that relocated to Phoenix during the boom are now slowing hiring or even laying off workers, further dampening demand for housing. In fact, some longtime residents are packing up and leaving, searching for more affordable places to live, as the cost of living in Phoenix continues to rise. Rising property taxes, insurance premiums, and utility costs are squeezing household budgets. Some are moving to smaller towns in Arizona, or even out of state, seeking relief from the financial pressures that have built up over the past few years. Sellers are now making major concessions just to attract buyers. Price reductions, closing cost assistance, and even home upgrades are back on the table as sellers compete for a shrinking pool of buyers. In some cases, sellers are offering to pay for mortgage rate buy-downs, or include appliances and furniture to sweeten the deal. The days of multiple offers and bidding wars are gone, replaced by a market where negotiation is once again the norm. Price cuts have become the new normal, with many homes selling for less than their original list price. The days of easy profits are over, at least for now. According to recent data, the median sale price in Phoenix has dropped by double digits from its peak, and some neighborhoods are seeing even steeper declines. Sellers who bought at the height of the market are facing tough choices, and some may be forced to accept losses if they need to move quickly. Phoenix is experiencing a sharp correction, with home values dropping and uncertainty clouding the market's future. The city that once led the nation in price growth is now leading in price declines. Experts warn that the correction could continue if mortgage rates remain high and economic uncertainty persists. Some analysts predict that it could take years for the market to fully recover, while others see this as a necessary reset after years of unsustainable growth. It's a tough time for sellers, but for patient buyers, this cooling market could offer a rare opportunity to finally get a foothold in Phoenix real estate. With more inventory, less competition, and motivated sellers, buyers who have been waiting on the sidelines may find deals that were unthinkable just a year ago. For those willing to navigate the uncertainty, the next chapter in Phoenix's housing story could be one of opportunity and renewal. Tampa's housing market soared over the past several years, fueled by a surge of new residents, low interest rates, and a booming economy. But now, sellers and homeowners are facing a new set of challenges that threaten to slow the city's once unstoppable growth. One of the biggest headaches is the skyrocketing cost of homeowners' insurance. In recent years, insurance premiums in Florida have risen dramatically, with Tampa being hit especially hard. Severe weather events, including hurricanes and flooding, have made insurers wary, leading to higher rates and in some cases, companies pulling out of the market altogether. For many buyers, these costs are simply too high to justify purchasing a home, and for current owners, the rising premiums are straining household budgets. As a result, migration into Tampa has slowed noticeably. During the pandemic, the city was a magnet for remote workers and retirees seeking sunshine and affordability. But now, with higher insurance costs, rising home prices, and increased competition, many would-be residents are reconsidering their move. Affordability is becoming a major concern, not just for newcomers, but for locals as well. The impact is clear in the local real estate market. Homes are sitting on the market longer than before, with fewer bidding wars and more price reductions. Sellers who once expected quick sales at record prices are now having to adjust their expectations, often accepting lower offers or making costly improvements to attract buyers. Open houses that used to draw crowds are now sparsely attended, and unsold inventory is slowly building up. Investors too are feeling the pinch. With higher insurance premiums, increased property taxes, and slowing rent growth, it's becoming much harder to make the numbers work on new purchases. Many investors are pausing acquisitions, selling off underperforming properties, or even exiting the Tampa market altogether. This pullback is reducing competition for homes, but it's also removing a key source of demand that helped drive prices higher in recent years. Despite these challenges, Tampa still has undeniable long-term appeal. The city's vibrant culture, beautiful waterfronts, and strong job market continue to attract people from across the country. Many believe that once the market resets and insurance issues are addressed, Tampa will remain a top destination for both families and retirees. For now though, the market is clearly in a period of adjustment, as buyers, sellers, and investors all wait to see where prices and demand will settle. Both buyers and sellers are learning to navigate this new reality. Buyers are becoming more cautious, carefully weighing the true cost of homeownership in Tampa, while sellers are adjusting to a slower pace and more competitive market. In the months ahead, the balance of power may continue to shift, but one thing is clear: Tampa's housing market is entering a new, more challenging phase, one that will test the resilience of everyone involved. Cape Coral, Florida became one of the nation's hottest housing markets during the remote work surge of 2020 and 2021. As people flocked to the Sunshine State in search of more space, lower taxes, and a better quality of life, developers raced to keep up with demand. Entire neighborhoods sprang up seemingly overnight, with construction cranes and new builds dominating the skyline. But this rapid expansion came at a cost. Overbuilding has now led to a classic boom-and-bust scenario. Developers eager to capitalize on the frenzy overestimated long-term demand. As a result, Cape Coral is now facing a significant oversupply of new homes, many of which remain unfinished or unsold. The city is left with a glut of new properties, creating a landscape of nearly identical homes stretching for miles. Many of these houses are sitting vacant, waiting for buyers who are now far more cautious than they were just a couple of years ago. With so many homes on the market, sellers are being forced to slash prices. Some properties have been discounted multiple times, and open houses often attract only a handful of visitors. The oversupply has put significant downward pressure on prices, especially in the newest developments. Builders are now offering aggressive incentives to attract buyers, everything from free upgrades and closing cost assistance to deep price cuts. In some cases, prices have dropped by tens of thousands of dollars compared to peak levels. This has created a challenging environment for anyone who bought at the top of the market. Existing homeowners are now caught in the crossfire. They're forced to compete with brand new homes that are being sold at a discount, making it much harder to sell older properties. Many are choosing to wait, hoping for a market rebound, but the reality is that inventory remains high and buyers have plenty of options. The rental market isn't immune either. With so many homes available, rental vacancies have climbed, forcing landlords to lower rents or offer concessions. Real estate investors who bought properties expecting quick appreciation or easy rental income are now struggling to fill units and cover their costs. Despite these challenges, it's important to note that Cape Coral's market is correcting, not collapsing. The city's fundamentals, like its desirable location and lifestyle, remain intact. However, the pace of sales has slowed dramatically and the days of bidding wars are over, at least for now. For buyers, this correction presents an opportunity. There are deals to be found, especially for those willing to be patient and negotiate. First-time buyers and those relocating from more expensive markets may find Cape Coral's current prices attractive, but they should be prepared for a slow-moving market. Still, don't expect a quick rebound. The oversupply will take time to work through, and both sellers and investors may need to adjust their expectations. Cape Coral's housing market is in a period of transition, one that could last for several years before stability returns. Orlando was one of the hottest real estate markets during the pandemic, drawing in buyers from across the country with its sunny weather, booming job market, and relatively affordable homes compared to other major cities. But as we move into 2026, the story has changed dramatically. Affordability has become a major stumbling block for both new buyers and longtime residents alike. Demand for homes in Orlando has softened considerably. With mortgage rates hovering near multi-year highs, fewer buyers are able to qualify for loans, and many are simply priced out of the market. The days of bidding wars and homes selling above asking price are largely over. Instead, open houses are emptier, and sellers are waiting longer for offers that often fall short of their expectations. As a result, homes are sitting on the market for weeks, sometimes even months, without serious interest. Sellers are increasingly forced to make concessions, whether it's covering closing costs, offering home warranties, or agreeing to price reductions just to keep deals from falling through. The inventory of unsold homes is slowly building, putting even more downward pressure on prices. Orlando's economy is heavily reliant on tourism and entertainment, sectors that have always been unpredictable. While the city benefits from world-famous attractions like Disney World and Universal Studios, jobs in these industries are often seasonal or subject to sudden downturns, especially when travel slows or economic uncertainty rises. This volatility makes it harder for many residents to commit to long-term homeownership, further dampening demand. The condo and townhouse markets have been hit especially hard. With single-family homes out of reach for many, buyers are looking for cheaper alternatives, but even these options are becoming less attractive as monthly payments climb and association fees rise. Investors who once snapped up condos for short-term rentals are now pulling back, wary of oversupply and declining nightly rates. Price reductions have become the norm, not the exception. It's common to see listings with multiple price cuts, and some sellers are even removing their homes from the market altogether, choosing to wait out the downturn rather than sell at a loss. This cycle of falling prices and shrinking demand is creating a challenging environment for both buyers and sellers. Despite these challenges, Orlando's underlying fundamentals remain strong. The city continues to attract new residents thanks to its climate, lifestyle, and job opportunities in tech, healthcare, and logistics. New construction is still underway in the suburbs, and mixed-income neighborhoods are expanding. But until affordability improves, Whether through lower interest rates, higher wages, or falling home prices, the market will remain under pressure. For now, affordability is the single biggest hurdle facing Orlando's housing market, and it's reshaping the dreams and decisions of thousands of families across the city. Over the past several years, Dallas has experienced an unprecedented construction boom. Developers, eager to capitalize on the city's rapid population growth and strong economy, broke ground on thousands of new homes, sprawling subdivisions, and luxury apartment complexes. The skyline of Dallas suburbs transformed almost overnight, with cranes dotting the horizon and new neighborhoods springing up where open fields once stood. But now, the market faces a stark reality. There's simply more inventory than there are buyers. Many of these newly built homes are sitting vacant, with for sale signs multiplying across entire blocks. Open houses attract fewer visitors, and some developments have become eerily quiet as demand fails to keep pace with supply. As a result, homes are sitting on the market for much longer than in previous years. The days of bidding wars and instant sales are over. Price appreciation has not only stalled, in some neighborhoods, values have actually started to decline. Builders, facing mounting carrying costs and pressure from lenders, are now offering significant discounts, incentives like free upgrades, and even covering closing costs to entice hesitant buyers. This aggressive competition from new construction is putting additional pressure on existing home prices. Sellers of older homes are forced to drop their prices or invest in costly renovations just to keep up. In some cases, homeowners who bought at the peak of the market now find themselves underwater, unable to sell without taking a loss. On top of these challenges, rising property taxes and soaring insurance premiums are making homeownership less affordable for many Dallas residents. Texas is known for its high property taxes, and recent increases have caught many by surprise. Insurance costs have also spiked, driven by severe weather events and inflation. These added expenses are stretching household budgets thin, causing some would-be buyers to delay their purchase or look elsewhere. For real estate investors, the situation is even more precarious. Many who bought properties expecting steady appreciation and strong rental demand are now seeing their profit margins shrink. Higher holding costs, longer vacancy periods, and increased competition from both new and existing homes are eroding returns. In some cases, investors are being forced to sell at a loss, especially those who over-leveraged or bought at inflated prices. Distressed sales and foreclosures, while not yet widespread, are beginning to appear in certain pockets of the Dallas metro area. Despite these headwinds, Dallas still boasts strong job growth and long-term economic appeal. The city remains a magnet for major employers, especially in tech, healthcare. Its diverse economy and business-friendly environment continue to attract new residents, which bodes well for the housing market's eventual recovery. For now, however, the market is working through a significant surplus of homes and a pool of increasingly cautious buyers. Many are waiting on the sidelines, hoping for further price drops or better deals. The balance of power has shifted. Buyers have more choices and leverage than at any point in recent memory. Patience is key for buyers in this environment. With so much inventory and motivated sellers, there's ample room to negotiate on price, terms, and even extras like repairs or upgrades. For those willing to wait and do their homework, Dallas could offer some of the best buying opportunities in years, but only for those who move carefully and strategically. Houston's real estate market is deeply intertwined with the city's broader economic landscape, especially its dominant energy sector. When oil prices are high and the energy industry is booming, Houston tends to see strong job growth, population influx, and rising home values. But, when the energy sector faces headwinds, the ripple effects are felt throughout the housing market. Over the past year, inventory in Houston has surged. There are now more homes on the market than at any point in the last 5 years. This spike is partly due to homeowners rushing to sell before prices fall further, and partly because new construction continues to add supply. The sheer volume of available homes is giving buyers more choices, but it's also putting downward pressure on prices. Sellers are finding it increasingly difficult to command top dollar for their properties. Many are being forced to lower their asking prices or offer incentives to attract buyers. Open houses that once drew crowds now see only a trickle of visitors, and many potential buyers are hesitant to make offers, waiting for even better deals as the market shifts in their favor. Economic uncertainty is weighing heavily on buyers' minds. With inflation still elevated and interest rates higher than in recent years, the cost of homeownership has risen sharply. Many would-be buyers are finding that monthly payments are simply out of reach, or they're worried about job security in a city so closely tied to the volatile energy sector. This hesitancy is slowing down the pace of sales and contributing to the growing inventory. Meanwhile, new construction continues at a brisk pace. Builders who started projects during the recent boom are now bringing thousands of new homes to market, even as demand softens. This ongoing influx of new inventory is tipping the balance further toward buyers, creating a highly competitive environment where sellers must work harder to stand out. While Houston isn't facing a full-blown crisis, the market is clearly in a period of correction. Prices are adjusting downward, and the days of bidding wars and rapid appreciation are over, at least for now. Local news outlets and community groups are closely watching these trends, and many homeowners are re-evaluating their expectations. For buyers, this environment presents a unique opportunity. With more homes to choose from and less competition, it's possible to negotiate better deals and take time to make informed decisions. However, it's crucial to stay alert to broader economic trends, especially those affecting Houston's energy sector and job market. The next few years could bring further changes, so buyers and sellers alike should proceed with caution and keep a close eye on both local and national economic signals. Denver's housing market experienced a meteoric rise during the pandemic, with home values surging to unprecedented heights as buyers flocked to the city in search of space, lifestyle, and investment opportunities. But as the dust settles, the market is now undergoing a significant correction, a necessary recalibration after years of unsustainable growth. Demand has slowed considerably, especially among first-time buyers who are now facing higher mortgage rates, tighter lending standards, and increased uncertainty about future price trends. Many would-be buyers are choosing to wait on the sidelines, hoping for better deals or more stability before making such a major financial commitment. As a result, homes are staying on the market much longer than they did during the frenzy of 2020 and 2021. Sellers, who once expected multiple offers within days, are now having to adjust their expectations and, in many cases, reduce their asking prices to attract interest. The days of quick, easy sales are over, for now. Bidding wars, which were once the norm in Denver's hottest neighborhoods, have become rare. Instead, price reductions are increasingly common, and sellers are often forced to offer incentives, like covering closing costs or providing home warranties, to entice buyers. Inventory has climbed steadily, giving buyers more choices and significantly more leverage in negotiations. This shift has transformed the market from a seller's paradise to a more balanced, or even buyer-friendly environment. For those who have been frustrated by years of limited options and fierce competition, this is a welcome change. Investors who bought at the peak of the market are now feeling the pressure. Many are seeing the value of their properties decline, and some are struggling to rent out or sell homes purchased at inflated prices. For those who over-leveraged or counted on perpetual appreciation, the current correction is a harsh reality check. Despite these challenges, Denver's underlying fundamentals remain strong. The city continues to attract new residents thanks to its vibrant economy, outdoor lifestyle, and cultural amenities. Job growth, population trends, and long-term demand for housing all point to a resilient market, one that simply needed a breather after years of runaway growth. For buyers, this is a time to be patient and strategic. There are deals to be found, but gone are the days of instant equity and guaranteed appreciation. Take your time, do your homework, and focus on finding a home that fits your needs and budget. The market is shifting, and those who approach it thoughtfully will be best positioned for long-term success. Boise was once the poster child for the pandemic housing boom, a city that saw its population surge as remote workers and families from pricier states flocked to Idaho in search of affordability, space, and a higher quality of life. Home prices soared at a record pace, with bidding wars becoming the norm and properties selling within days, sometimes even hours, of hitting the market. But now, the landscape has shifted dramatically. Prices are falling fast, erasing much of the rapid appreciation seen during the boom. Inventory has ballooned, with the number of homes for sale in Boise reaching levels not seen in years. the market has transitioned from a seller's paradise to a far more balanced, if not buyer-friendly environment. Buyers, once desperate to secure any available property, are now waiting on the sidelines, anticipating further declines. Many are cautious, aware that overpaying in a falling market could mean years before regaining equity. The sense of urgency that defined the pandemic era has evaporated, replaced by patience and careful research. Sellers who bought at the peak, often stretching their budgets to win bidding wars, are now facing the harsh reality of negative equity. Many are forced to accept losses if they need to move, while others are choosing to stay put, hoping for a rebound that may not come soon. The emotional and financial toll is significant, especially for those who expected Boise's meteoric rise to continue indefinitely. The rental market, once red-hot due to in-migration and limited supply, has softened considerably as migration slows and new construction adds to available units. Landlords are finding it harder to fill vacancies, and rental rates have plateaued or even declined in some neighborhoods. Incentives like free first month's rent or reduced deposits are becoming more common as competition for tenants increases. Investors, many of whom purchased properties at inflated prices during the boom, are now grappling with negative cash flow or extended vacancies. Some are being forced to sell at a loss, while others are holding on, hoping for a turnaround. The days of easy profits from short-term appreciation are over, and the focus has shifted to long-term fundamentals and risk management. Despite these challenges, Boise remains a desirable place to live, with strong community ties, outdoor amenities, and a relatively low cost of living compared to coastal cities. However, the market is clearly resetting, and both buyers and sellers must adjust their expectations to the new reality. For buyers, patience is key. It's more important than ever to do thorough research, understand local trends, and avoid rushing into a purchase. With more options on the market and less competition, buyers can take their time, negotiate better deals, and ensure they're making a sound investment for the long term. The days of double-digit appreciation are over for now. Boise's housing market is entering a period of correction and stabilization, which may ultimately lay the groundwork for healthier, more sustainable growth in the future. For now, both buyers and sellers must navigate a market that looks very different from the frenzied boom of just a few years ago. Las Vegas has always been a city defined by risk and reward, not just in its casinos, but in its housing market as well. Known for dramatic boom and bust cycles, the city is once again facing a challenging year in 2026. The echoes of previous downturns are hard to ignore, and many residents are wondering if history is about to repeat itself, or if the city can chart a new course. After a period of rapid price appreciation during the pandemic, the momentum has come to a halt. Home values that soared in 2021 and 2022 have now plateaued, and in some neighborhoods, prices are beginning to slip. The local job market, heavily reliant on tourism, hospitality, and entertainment, remains volatile. Layoffs and reduced hours have left many homeowners uncertain about their financial future, and this instability is rippling through the housing sector. Demand for homes has cooled significantly. The frenzy of bidding wars and above-asking offers has faded, replaced by a growing inventory of unsold properties. Open houses that once drew crowds now see only a trickle of visitors. As more listings hit the market, buyers have become increasingly selective, and sellers are finding it harder to attract serious offers. In response, sellers are slashing prices, sometimes multiple times, just to generate interest. Homes are sitting on the market for months, and the days of quick sales are over. Many properties now feature price-reduced banners, and some owners are even offering incentives like covering closing costs or providing home warranties to entice buyers. Oversupply is becoming a serious concern. Builders who rushed to meet pandemic-era demand are now facing a glut of new homes. Entire developments sit partially occupied, with construction paused or slowed as developers wait for buyers to return. This excess inventory is putting additional downward pressure on prices and making it even harder for existing homeowners to sell. Investors, who once flocked to Las Vegas for high returns, are now facing tougher conditions. Rents have stagnated, and in some cases are beginning to decline as supply outpaces demand. Vacancy rates are rising, and landlords are offering concessions like free months of rent or reduced deposits to fill units. The days of easy profits are over, and many investors are reevaluating their strategies. Despite these challenges, Las Vegas is not in freefall. The market is undergoing a necessary reset after years of unsustainable growth. While prices are correcting and activity is slowed, there are signs of underlying stability. The city's population continues to grow, and long-term fundamentals, like affordability compared to coastal markets, remain relatively strong. For buyers, this environment presents both risks and opportunities. Those willing to do their homework and negotiate aggressively can find good deals, especially on homes that have lingered on the market. However, patience and a long-term perspective are essential. The market may take time to fully recover, and buyers should be prepared for potential further price declines before stability returns. In Las Vegas, as always, the key is to play the long game and avoid betting more than you can afford to lose. As we close out this deep dive into the 2026 housing market, let's remember the big picture. While the headlines may be dramatic, this isn't a repeat of 2008. Today's market is fundamentally different, with stricter lending standards, more homeowner equity, and a far lower risk of widespread foreclosures. Banks have learned from the past, and buyers are better prepared. Most homeowners are in a stronger position, and the market as a whole is more resilient, even as some cities face corrections. The key takeaway: we're seeing a reset in overheated markets, not a nationwide crash. Many regions remain stable or are even growing, and the overall outlook is far less dire than some might fear. For buyers, this is a moment to be smart and strategic. Take your time, do your research, and negotiate with confidence. For sellers, realistic pricing and flexibility are more important than ever. The days of instant offers may be gone in some cities, but with the right approach, both buyers and sellers can find opportunities. Remember, real estate is local. While some markets cool, others are thriving, especially in the Midwest and Heartland, where affordability and job growth continue to drive demand. The bottom line: opportunities and risks will depend on your local market. Stay informed, be patient, and make decisions based on your unique situation, not just the headlines. So, what should you do next? Keep learning, consult trusted professionals, and don't rush. Whether you're buying, selling, or just watching, preparation and knowledge are your best tools. If you found this video helpful, don't forget to subscribe for more insights on the housing market and personal finance. Share your thoughts or questions in the comments below. What's happening in your city? And if you know someone navigating the market, share this video to help them make informed decisions. Thanks for watching, and here's to making smart moves in 2026.